So let's have the statement of financial position. Yeah, we're still continuing with the example in single entry. So B and C, we are using the same example as we used in the previous video of single entry and incomplete records. So B and C's statement of financial position, also known as the balance sheet, as at 30th June 2023. So we always start with fixed assets. The fixed assets, we have the cost, we have the depreciation or the accumulated depreciation, then the net book value or the NBV. So they are all in UGX 3 zeros, or you can put it up here, UGX 3 zeros. Yeah, so this was our question. So we start with the fixed assets. We only had 2 fixed assets, this and that. So the cost, these were the costs. So we have 12,000. We have furniture, and fittings, which is 12,000. Then equipment, it is 240,000. Then the depreciation, according to our statement of profit or loss, we determine the depreciation, this 600 and then 12,000. So 600 and then 12,000. The net book value, we get this minus that to get what we put here. So here is my calculator. 12,000 minus 600, 11,400. Then 240,000 minus 12,000, 228. That's the net book value. Then you get the total fixed assets, this plus that. $239,400. Yeah, then we go to the current assets. Current assets. So when it comes to current assets, we have things like inventory, trade receivables, bank, things like that, and we only record the closing balances. So according to our cash book, this was the closing balance for the cash book. Yeah, let's consider it to be bank. So we write bank. Our closing balance was this, the balance brought forward or balance carried down, 67,000. Then we have trade receivables, but we only record the closing balances in the balance sheet. So this 280 trade receivables is 280,000. Then we have bills receivables. We record the closing balance, which is 100,000. So bills receivables, we have 100,000. We also have closing inventory. So closing inventory, it is here, 468. 468. Then according to our additional information, we had insurance that was prepaid. Any prepaid expense is regarded as a current asset. So insurance prepaid of 5M, like that. So we get the total of the current assets. So 67 plus 280 plus 100,000 plus 468,000 plus 5,000, 290,000. Then we go to equity. And liabilities. We start with equity, whereby we're supposed to start with capital. But in this question, we were not given capital, but we were given the opening balances. These were the opening balances. So meaning we are going to prepare the statement of affairs to determine the opening capital. So statement of So for the statement of affairs, we get assets, the total assets, we subtract the total liabilities of the opening assets and liabilities, this one. So we identify the assets. This is an asset, inventory is an asset, receivables is an asset, this is a liability, this is an asset, this is a liability, these are assets. So we get the total assets minus the total liabilities, we get our opening capital. So assets, these are the assets: inventory, trade receivables, bills receivables, furniture, equipment. Then their total is here. Then we list liabilities, trade payables, then bills payables, which is that. So this minus that, what we get is the opening capital. So that's how we get it. So we come here and we write that capital 746 in our balance sheet. Then we're supposed to add net profit from our statement of financial position. The net profit that we got, it was 200. That was the net profit from our profit or loss. Then we less drawings. We less drawings. According to our question, we had drawings somewhere. We had drawings of 310. So we less drawings of 310,000. Like that. So this versus minus that. Seven, 4, 6 plus 291, 800 minus 310,000. So that the net equity is going to be 727,800. Then we go to liabilities. Liabilities, we have the long-term liabilities and then the short-term liabilities, or the current liabilities. But long-term, it is anything that is beyond 1 year. And in this question, we didn't have any long-term liabilities, so we shall only have the current liabilities. Long-term liabilities are mainly loans. So current liabilities, we have things like trade payables, then bills payables. Then according to additional information, we had these accrued expenses. Accrued expenses, the closing figures, the closing balances, when they're accrued, they are treated as liabilities. So those are the current liabilities that we are going to have. We have trade payables. I told you in the balance sheet we only write the closing figures. So trade payables, this 30,000 is what we write. Then bills payables, the closing figure, bills payable, the closing figure is 24,000. That's what you write here. Then we have the accrued expenses, wages 60M. So wages 60,000. Then we have wages accrued. We also have salaries accrued. Now 24M. And then we have legal costs accrued of 14M. So we get a total 30,000 plus 24,000 plus 60,000 plus 24,000 plus 14,000. So the total is going to be the total is going to be 152,000, like that. So that is the total liabilities. $152,000. So that is our balance sheet. That is how we deal with the balance sheet. We only write there the closing figures. So thanks for watching. Do not forget to subscribe, like, comment, share with your friends, and let's catch up in my next video.